Good morning, traders. Today we are looking at euro against the yen, as you can see on the chart, which has broken out. I would say, well, you can consider it like to be a triangle or some sort of range bound consolidation. Either way, it is a continuation pattern, and we are now retesting the 182 level as support. You see, that's the top, that's the peak, and this is a retest that we see the 4-hour chart falling down towards the that handle. So let's walk through the macro drivers and the key technical levels together, and then finish with a trading structure. Let's just call it. So euro yen consolidated roughly between the 179.75 and the 182 level, and broken out that trend line support around the 181.30 level also, right? So this is, of course, a continuation pattern, as I was just clearly saying earlier. And now with this breakout, we do get the measured move extension potentially, okay, uh, giving us the 182 84, excuse me, um, 27, and then in the intermediate um, level we get the 182.86 and the 183.40, let's say, okay. And this is of course the 100 fibor of fat level. There is a different way to do the measured move. You can use the breakout level as well, if you may, and that brings us to 183.50. But let's just stick to the more structural and typical stuff. So why is this breakout taking place? Let me walk you through. First, um, we need to take to go back a little bit in November. In late November, Japan approved a huge stimulus package to support a weakening economy. And then in early December, we also saw revised Q3 GDP figures. Economy contracted. So basically, we get a combination. We get fiscal stimulus into a weakening economy. Okay, so there is some sort of arguments that the Bank of Japan is going to hike in December, and indeed that's the case. However, um, the reality is that they're going to be doing so in a weakening into a weakening economy, and Japan's jet GDP ratio as well is already 240% of its well of its GDP. So there are, of course, a lot of concerns, and yields have also surged, and they are surging. Um, the ECB, on the other hand, is not expected to hike, but it's not expected to cut either. Okay. And the reality here that we're facing is that the ECB is not expected to cut at all next year. And the BOJ is expected to hike, but it's expected to be the last hike. Okay. So we have to take all of that into consideration and understand that the macro environment is actually supportive of this breakout, this move to the upside. We also need to look in the US side. The Fed is expected to cut versus the ECB, which isn't. So the euro is supposed to get some support from a weakening dollar as well. Okay. Now we do have, of course, a narrow side divergence here on the 4 hour that we need to worry about. However, this doesn't really invalidate the entire structure, right? However, it is likely that if the 182 level doesn't hold, which is the very recent bottom here that we see, we could go and retest the top of that triangle and then continue higher. Losing that low, of course, will get us to the next trend line support, and then perhaps we could move higher. Or if we don't move higher, we might just be retesting that level and then moving lower down. All of this is possible, but the current macro environment is supportive of either a continuation to the upside if 182 holds, or even if we do move lower, okay, even down to 179 to be fair, we could still move higher up. Okay, this is looking like a some sort of terminal in the short term pattern. Okay, because the problem with continuation patterns, because they typically happen before the last leg to the upside, it's this. Yes, they are continuation patterns, but the moment we break above the previous high, that is a moment where we don't really know. We have to make assumption, of course, where the end is going to take place. So how am I trying to figure out how that could play out? We're going to see at the one and the two and the three and the four. So we go with one net four. The 161 is up over here. So we are just now above the 161. This makes the 181.62 a very important level. Okay. And as long as we remain above that level, to me, this remains a um, the upside is favored. We can do a similar um, we can take a similar net move, okay, which sees that 1 and 2 and 3 and 4 as a flat and 5. Again, this brings us at the 61.8 exactly in the middle of the triangle. Another very important level, 180.83. And the 100% is up to the 183.95. Again, it matches with our expectations. Just to give you here an idea, okay, because now the concern is that we are actually at a last leg to the upside. Okay, what I would be looking potentially is to go long right at the middle, pretty much. So because we do have this 4-hour divergence, okay, I will be putting my stop just below the previous low, this bottom, and the target is going to go, of course, higher up. So I will be looking for a potential decline down here, and then a continuation to the upside. Because although we are indeed in this last leg, I believe this is a 5-wave leg that is part of a larger 5-wave leg. We're going to get 3 and 4 and a 5. Okay. So in terms of levels, we know we can use the reverse Fibonacci, if you may, okay, and look for the 138.2, 161.2, and then of course the 200, which is not different to what we show we looked at earlier. But just to give you a bit more perspective, 182, 88, pretty much we came already here. 183, 42, and then you've got 184, 29. So this would be essentially 185 target, right? One of the targets that I would be looking to close in most of the position. The most ideal scenario, if we entered over here, would be to let the trade run up to 138.2, take like 20% out here. Then at 61.8, we would take the other 30% and we'll leave 50% to run. And once prices get to the 161.8, we will essentially move our stop to break even. Okay, and once we do break above 183.42, okay, then we'll be looking to trail that stop. To trail that stop, let's say like 200 pips or so, okay, and just let that run, because essentially the 184.29 doesn't necessarily stop us, but trailing it takes advantage of any further upside potential, okay, whereas on the downside we are still keeping protecting. We would have already taken out, and that is of course an idea of securing profits while also managing potential risks to the downside appropriately. So the bottom line is on the macro technical mix, I would say Japan is pumping fiscal stimulus into a shrinking economy. Yields are spiking on debt concerns, not growth. The BOJ is expected to hike, but of course it's probably the last one. And ECB is gonna be stable, probably supportive from a FOMC, dovish FOMC into 2026. That would likely keep the weak the yen yuan and the carry trade probably not going to see much inflows, if that makes sense, which might, by the way, be supportive for the another European currency, the Swiss franc. But let's just not delve into these details. Technically, we've broken out now the 182 level, okay, but 180 70, I would say, is the line in the sun for me, and the 180, then if we are, as long as we're above that level, then the bias remains to the upside.